Equities are celebrating softer U.S. jobs data, even as long-term yields and geopolitical risks keep flashing amber for risk assets. This is vTalkInsight, Equity Pulse Daily for August 10, 2026. We will unpack how the labor wobble, the AI investment boom, and a fragile bond market are colliding to shape today's equity backdrop. U.S. macro data have pivoted sharply toward weaker labor momentum. July payrolls showed an unexpected loss of 23,000 jobs, with prior months revised down and a three-month average near 20,000. At the same time, average hourly earnings rose only 0.1% on the month and 3.2% year-over-year, easing wage pressure but raising questions about the durability of consumer spending. Markets quickly translated that mix into a softer perceived policy path. Odds of a Federal Reserve rate hike in September have fallen from above 50% to around 40%. Two-year Treasury yields dropped into the low 4% area. The dollar weakened against peers such as the yen and Norwegian krone, and both equities and gold rallied as traders leaned toward a gentler, or earlier, easing cycle. Further out the curve, yields remain a source of unease. 10-year Treasuries are still near 4.6% and the 30-year above 5%, under pressure from budget deficits above 6% of GDP and heavy global issuance, including AI-related corporate borrowing. Several views warn that if long-dated yields drift closer to 5%, equity markets may have to reprice more abruptly. Yet the rates backdrop is not one way. Bond market volatility is unusually low and the 10-year has traded in an exceptionally tight range around 4 to 4.6%, helped by strong demand for treasuries, Federal Reserve dollar liquidity backstops, and talk of shifting issuance toward maturities, where demand is deeper. Attention now turns to upcoming consumer and producer inflation reports, which are likely to be the next major catalyst for both yields and equity risk appetite. Against that macro backdrop, the equity tape still looks remarkably resilient. The S&P 500 has seen only modest pullbacks even amid Middle East tensions and higher yields, and roughly 75% of its constituents trade above their 200-day moving average. That breadth marks the healthiest internal participation in more than 2 years and suggests the rally is no longer confined to a narrow group of leaders. Importantly, this advance is being powered by earnings rather than pure multiple expansion. Overall S&P 500 earnings growth is running in the high 20s, with 8 of 11 sectors contributing and recent gains tilted toward financials, industrials, and healthcare. Valuations have actually compressed as profits outpace prices, which supports a more cyclical, but also more correction-prone, environment. The main tension is sentiment. Positioning indicators show extremely bullish attitudes, similar to 2021, even though not all portfolios are fully reloaded yet. Upside scenarios hinge on continued solid growth and a Federal Reserve that stays on hold, while repeated hikes or a sharp backup in long-term yields could quickly undercut this positive momentum. Many desks are watching breadth and sector rotation for early warning signs that the balance is shifting. The clearest structural driver remains the artificial intelligence capital spending boom. AI-related investment is projected around $3.2 trillion between 2026 and 2028, with roughly $1.5 trillion financed through credit. Recent estimates suggest that could add 2 to 3 percentage points to U.S. GDP growth, while supporting a notable upturn in productivity and record S&P 500 profit margins. That growth, though, is being debt-funded. High-grade technology bond issuance has exploded to about $200 billion this year from a little over $10 billion a year ago. Alphabet's recent $25 billion deal drew roughly 4 times as much demand, yet required spreads of about 1.3 percentage points over treasuries, signaling that investors now want more compensation for AI capex risk. Spreads on high-quality issuers such as Microsoft and Amazon are expected to widen over the coming quarters, and some large tech bonds have already slipped below issue price. At the same time, credit conditions still look benign overall, with tight BB spreads and strong global bank equity performance. Some see better potential risk-reward in high-yield AI bonds, which may benefit from rating upgrades, than in crowded investment-grade paper. For equities, the message is that AI is both a growth engine and a balance sheet story. SK Hynix's plan to spend $38 billion doubling memory output in South Korea underscores confidence in sustained AI semiconductor demand. But ongoing heavy capex and rising funding costs, as seen in Oracle's downgrade to the lowest investment grade notch, make AI-exposed sectors more sensitive to any future shock in long-term yields or credit spreads. Geopolitics continue to lurk in the background. Persistent tensions involving Iran, including intermittent attacks on shipping and threats to the Strait of Hormuz, have effectively halted Gulf liquefied natural gas exports and pushed many routes away from the Suez Canal and around the Cape of Good Hope. Bunker fuel prices are up about 60% since February, feeding into global goods and energy costs. The result is a supply chain regime that many now see as a new normal rather than a temporary shock. Smaller logistics firms are struggling to pass through higher diesel and operating expenses, in contrast to large retailers, and face mounting margin pressure. U.S. West Coast ports like Los Angeles report record throughput and new infrastructure investment, but they are effectively absorbing cargo that used to move more cheaply through other corridors. Climate risks and raw materials add another layer. Widespread European wildfires are expected to result in several €100 million of losses, complicating earnings visibility for insurers such as Munich Re even as peers like Allianz deliver strong profit beats. Meanwhile, copper prices have surged around 50% year-to-date as AI, defense, renewable power, and electric vehicles all compete for constrained supply, a mix that supports long-term electrification themes but also keeps input costs elevated. At the micro level, earnings are giving a rich cross-section of how these themes play out. Microsoft's latest results highlighted accelerating commercial cloud revenue and early AI monetization, while Cloudflare's shares jumped more than 15% after strong guidance showed that workforce reductions had not slowed growth. Cybersecurity demand remains robust, with Gen Digital lifting its full-year earnings outlook, and cloud infrastructure firm Okami committing over 40% of revenue to capex ahead of an expected fourth-quarter growth inflection. Consumer-facing names tell a more uneven story. Airbnb has raised its full-year outlook for a second time, with shares rallying on strong travel demand in the US and Europe and a boost from first-time users around the World Cup. In contrast, Sweetgreen has sharply cut its same-store sales guidance, now expecting a 7 to 8% decline as food safety concerns and price sensitivity weigh on traffic, while Wendy's has withdrawn guidance amid sales struggles that contrast with strength at McDonald's and Burger King. Within technology, dispersion around expectations is widening. Microchip technology rallied after issuing earnings guidance above forecasts, adding to evidence of resilient demand in parts of the semiconductor complex. Trade Desk moved the other way, with the stock plunging on disappointing revenue guidance and multiple analyst downgrades, underscoring how unforgiving the market can be when high multiple, advertising-exposed names fall short. European and private market signals are equally telling. Italian banks, including Monte dei Paschi, are beating earnings expectations and attracting takeover interest from Intesa Sanpaolo as the government prepares to sell its remaining stake, pointing to ongoing consolidation supported by higher rates. Defense contractor Rheinmetall still expects more than 30% annual growth despite the loss of a German naval contract, helped by a potential multi-decade order in negotiation, while Apollo's acquisition of EasyJet suggests private capital remains willing to fund capacity growth even as public markets debate the cycle. To pull this together, equities are trading as if the Federal Reserve has regained some room to be patient, thanks to softer jobs and wages, yet long-term yields, deficits, and geopolitical supply shocks mean the cost of capital remains elevated. Earnings and AI-driven productivity are doing the heavy lifting, with broad sector participation offsetting pockets of consumer and advertising-related weakness. From here, the key markers are clear. The next rounds of inflation data, whether 10 and 30-year yields stabilize or grind toward 5%, and how credit markets absorb the next wave of AI capex funding. Together with ongoing geopolitical and climate risks, They will determine whether today's broadening rally can extend or needs to consolidate. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.